Welcome. Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, a publication of tax analysts, the preeminent source of information for tax professionals in the United States and around the world, in preparation of this program. Let's see what we've got to talk about this week. It was a slow week. Holiday in the middle of the week didn't help any, but we have 3 items, and then I have some comments I'd like to make about the upcoming tax season. We have proposed tightening of rules allowing a partnership to opt out of centralized partnership audit regime, something that's causing some difficulty as we plan for compliance for 2020 returns. Final like-kind exchange rules modify the definition of real property, again. Then we have interim guidance on application of the tax law to disaster losses. I got all excited when I saw this item come through on the wire, but then I tried to find it with 3 different search engines and I couldn't find it. I've given you a reference, so maybe you can look for it. Finally, I'm going to talk about the upcoming 2021 tax season, where we work on 2020 returns. Our first topic is opting out of the partnership audit regime. This is regulation, proposed reg 123, 652, etc., etc. Which partnerships cannot opt out? A partnership with a qualified subchapter S subsidiary as a partner cannot elect out. Partnerships with disregarded entities as partners cannot opt out. And what counts as a disregarded entity includes a wholly owned entity disregarded as separate from its owner for federal income tax purposes. That expanded definition includes a qualified real estate investment trust subsidiary and any grantor trust. Which partnership-related items are excluded from the centralized partnership audit regime? And there are alternative rules provided for them. Next, we've got final like-kind exchange regulations, and it takes 3 slides to get this done. First, these are preliminary final like-kind exchange regulations, again, for the 3rd time. The IRS and Treasury are having a hell of a time getting this right, and they're catching all kinds of flack from practitioners, no matter what they try to do. But for now, these are the rules. These regulations expand how much state and local law is going to control determination of the classification of property as real property. At one point, the regulations said state and local law didn't matter at all. Then they said, well, state and local law matters a lot. And now they say, well, it may matter. So you make sure that you can make a note of what the regulations were on the day that you may have written a memorandum analyzing the tax law for a client. So the regulations in this pre-release version provides guidance to implement recent statutory changes to Section 1031 on like-kind exchanges. That's the whole idea, so we can comply with the law. The final regulations now state that property is classified as real property for purposes of Section 1031 if it is classified as real property under state and local law, subject to some exceptions. It is specifically listed as real property in the final regulations, or it is considered real property based on all the facts and circumstances under the factors that are provided in the final regulations. So there are three categories that property is classified as real property for purposes of Section 1031 if it meets one of those 3. The purpose or use test, which was in the regulations preceding this version, under which the function of property was considered in determining whether it was real property or not, is eliminated. That's gone. Finally, the final rules retain the incidental property rule, a 15% threshold, but it doesn't exactly operate the way you might think. The incidental property rule disregards an incidental amount of personal property as part of an acquisition of real property in a deferred exchange. But the gain on that is not deferred. An incidental amount in a deferred exchange is an amount of otherwise classified personal property with an aggregate fair market value not exceeding 15% of the aggregate fair market value of the replacement real property. So if you're under that 15% threshold, you haven't blown the tax-deferred exchange. However, while such an amount does not bust the deferred exchange, gain is required to be recognized to the extent of the gain on such property. So the 15% threshold doesn't protect the taxability of gain in the personal property, it just protects the overall tax deferral of the transaction. Next, disaster tax law changes explained. Oh boy. I looked for this item, this Small Business Self-Employed Division Bulletin, number 25, whatever. I looked for it with 3 different web browsers. I looked for it with Firefox, Microsoft Edge, Google. None of them could find it. The best I could do was get to the IRS website and get a referral to topic number 107, tax relief in disaster situations. So I recommend that you follow up on this if you are concerned about the current state of the tax law regarding disaster losses, claims for refund, insurance claims, how to calculate the amount of a loss, that you continue to pursue topic number 107 at www.irs.gov. This guidance, which was supposed to come from the Small Business Self-Employed Division, although they say it has been approved for publication, is simply not out there. When we find it, it's going to include the Disaster Program Office's implementation plan and the impact of all new, put that in quotation marks, legislation on disaster tax relief, because you can pick your latest new tax law. The way things have been going, we've had a new tax bill every year, and some of them have retroactively changed the prior law. At our deadline for producing this part of the program, the information was simply not available. Finally, this week, I jotted a few notes about the 2021 tax season. CPAs know it well. Every autumn, the urgent need to catch up on current developments affecting year-end tax planning for important clients, and then all the minor changes in credits, inflation adjustments, and parts of the Internal Revenue Code becoming effective in the new year, along with others that expire. This year, 2021, doing returns for the year 2020, the whole process is even more difficult due to changes in the law that were modified or effectively repealed before they became effective. Some changes made by the Tax Cuts and Jobs Act of 2017 were retroactively reversed before they became effective by the Bipartisan Budget Act of 2018 and/or the Coronavirus Aid, Relief, and Economic Security Act of 2020. Add a couple of retroactive changes in the Further Consolidated Appropriations Act of 2020, applicable to tax year 2018 and after, and the opportunity for error is seriously amplified. By the way, you cannot rely on the software if you don't know what to expect. So here we are, the end of November, 1st of December. We've got about 45 days, well, we've got less than 30 days to know what we need to know to give our clients good year-end tax advice. And we got less than 60 days to learn what we need to know to give our clients good service in tax compliance. And so the need is urgent to make sure that we involve ourselves in the continuing professional education programs offered by our state society, our state association of CPAs. There's never been a more urgent time to do that. I encourage you to go to www.scapa.org and check on the availability of tax updates. There's a team tax update coming up on December the 3rd, and there are other tax updates coming up the first week of January. Don't miss it. And as always, thank you. And as always, stay safe. We need every one of you.